Hi, everyone. Welcome back to another episode on the Indicott Invest channel. Today, we're going to talk about Zeta. So, Zeta has earnings in about a week. And I wanted just to highlight again sort of my bullishness on Zeta, how undervalued they are. Go over some numbers, just go over overall points on Zeta as we do have earnings coming up. I'm not doing an earnings prediction in this video, but I just want to kind of highlight more of Zeta, who they are, and kind of go through some earnings. So, well, not who they are, but why I think they're undervalued. So if we go ahead and I'll zoom in here so you guys can see this. If we go ahead and look at Q3, we're going to go over, highlight their earnings last quarter, talk about the guidance raise they gave in late November, and then go ahead and talk about some more of the Zeta financials and kind of go into why I think they're undervalued. So, and if you see the dog in the background, and go ahead and enjoy the view coming up on the couch. But yeah, so Zeta Global reported their 17th straight beat and raise quarter last year or last quarter. I'm personally thinking we'll see this again, and it'll be the 18th straight beat and raise quarter, as they'd like to advertise it. It delivered revenue of 337 million, an increase of 26% year over year. Generated net cash provided by operating activities of 58 million, an increase of 68%, and a margin of 17%. Free cash flow of 47 million, and a margin of 14%, and achieve the rule of 40 on a free cash flow margin and revenue growth, which is awesome. So there, I think the rule of 40 is quite literally in this example 40, which I think we'll see it go up over the future. But that was the rule of 40 last quarter. They went through and talked about they're increasing their full year 25 revenue, adjusted EBITDA, and free cash flow guidance by more than the 3-quarter beat. Um, Initial 2026 guidance calls for a sixth straight year of revenue growth over 20% with free cash flow margin expansion, which is great. You love to see that. Then they come out, and I guess we'll go ahead and look at more of the numbers, just more of some numbers here in terms of what Zeta did. So again, this is Q3, 15 straight quarters of 20% plus growth, and 19 consecutive quarters of its expanding adjusted EBITDA. So again, 26% growth here, 46% for adjusted EBITDA. I really love how they highlight or break out their customer and scaled customer count. So again, here was their 18 consecutive quarters of sequential scaled customer expansion, which is interesting that it must have been one of the quarters because they had 19 consecutive quarters here. It must have, I don't know, had a random quarter that didn't hit it. But again, they have 100. Last quarter was 180 customers of above a million and 392 customers above 100K to 1 million. So they actually, you can see here, lost a little bit of the 100K to 1 million, but that's because I'm assuming, well, we don't know exactly, but I'm assuming, and they might have talked about it on the call, that a few of these customers or 18 of these customers moved up to the 1 million plus, which means customers are spending more on the platform, which is great. Again, they said Zeta 2028 model CAGR is 48%, 4 to 8% for their sequential scaled customer expansion. Continued scaled customer ARPU expansion. So this is the average revenue per user is ARPU. Again, year-over-year growth is only 4%, and they're CAGRing or modeling a CAGR of 12 to 16%. They also talk about their powerful revenue leverage as customers ramp to a million, greater than a million. So here is again a good example of 1630 and 3.2. So their quarterly RPU was 1,630. This might be in thousands, so that might be a little more. It might be 16 million or something. Or no, it wouldn't be 16 million. It'd be 160,000. But again, they also talk about their average channels per customer here. So 3.2, 3.1 the previous quarter, 2.9. And so again, I'll be looking at all of this for next quarter to see, are they continuing to grow this? Is this continuing to expand? And again, the longer our customer stays with us, the bigger they become. This is a big reason as why I like Zeta. You can see here, under the first year, 8% of trailing 12-month revenue, 1 to 3 years, 16%, 3 to 5 years, 17%, 5+ years at 59%. So the longer you stay on the platform, the more revenue they get from that customer, which I think we'll see, and it kind of just shows the value of Zeta and the platform moving forward. Another reason why I like Zeta is how well diversified they are across all marketing channels. Well, not just marketing channels, but I guess the industries they're in. So the vertical. So we have consumer retail, insurance, telecom, financial services, political candidate and advocacy, education, travel and hospitality, healthcare, automotive, technology. So again, they're across 15 different industries. 7 of the 10 verticals grew greater than 20%. The top 5 fastest growing ones, this is interesting, were automotive, consumer retail, insurance, political candidate and advocacy, and technology, of course. They also serve 44% of the Fortune 100, so 44 customers of the Fortune 100, which is really awesome and really cool to see. I'm curious to see, what this becomes next quarter, as they continue to show it. They also gave their 2028 guidance, but this is really interesting. So I'll be looking for this as well as their next earnings. Like, are they going to go ahead and show another 2028 guidance track and increase the numbers here? Um, so for 2026 year end, they got at 1.54 billion. 2028, they gave 2.1 billion. Um, I don't know what that implies in terms of growth, but it says an implied 20% CAGR, I guess. So I guess that's more of what they're looking for. Adjusted EBITDA, 25% margin. So again, they're doing guiding for 274 million this year, 354 million next year, and 525 in 2028. And same with free cash flow. They're guiding for 16% free cash flow for 2028, versus the 14% they're guiding for this year, 2026. Which is interesting. I feel like that free cash flow margin is pretty sandbagged. And so that's interesting. But again, we'll keep looking for it. Now, I don't want to go through and do all of their guidance or do all of their metrics, but I want to kind of go ahead and look at their full year 2025 guidance. So they gave initially, this is Q3. We'll go over what they gave the revamped guidance 3 weeks later. But this is their revenue growth they guided for 2025 was basically 1.275 billion billion in revenue for full year 2025, and they gave that adjusted EBITDA and the free cash flow. Um, Again, this goes through their actuals and midpoints and kind of a lot more information here. The other thing, which is really interesting, they got it for 1.54 billion in 2026, so a 21% growth, and they gave their free cash flow and adjusted EBITDA. Now, let's go ahead and talk about where this actually increased to. So, on that graphic, or on what we just looked at, their guide for Q4 was 363 million. Well, about 3 weeks later, so that their earnings was November 4th. This guidance came out November 24th. So 3 weeks later, they came out and said, actually, we're going to do 380 million. And that's because of their acquisition of Marigold. But they came in and got it for 363 million for Q4, and then they got it for 380 million at the midpoint. Which again, we always know the sandbag. So let's just, I don't think we should always assume, but I think it's really unlikely to see them come in and not do at least 382 million this quarter. So again, they're a guiding for 380 million at the midpoint for Q4 earnings. If we look at their adjusted EBITDA, they're guiding for 90 to 90.7 million. During their Q4 guidance, I believe they gave 90.1 million. So that stayed pretty in line with what they were expecting. Nothing really changed much there. And then they also maintained their fourth quarter free cash flow. Their full year revenue for 2025, they guided for 1.263. They are guiding for, let's take a look here. They're guiding for 1.275. So again, a little bit of a beat, 1.29. So a bigger beat there, about a $15 million beat thanks to the Marigold, which again, we know they love to sandbag. Not saying they will, not saying it's guaranteed, but we know they like to do that. They increased their adjusted EBITDA and they maintained their free cash flow guide. And the big one was their first quarter or full year 2026. So for full year 2026, they initially, remember, they got it for 1.54 billion. Well, now they got it for 1.73 billion. So a $200 million raise. And we, again, just to reiterate again, we know they like to do the beat and raise. And so that 1.73 billion is probably a sandbag, if we were to guess. And I bet they come probably over 1.8 billion in revenue for full year 2026. Now, again, that just highlights more of, more of their guidance for 2026 and just moving forward. I want to go into what the analysts think and some estimates here. So we'll go ahead and I'll pull up we'll pull up some charting on Fiscal AI. Love this platform. But again, here I'll go ahead and show this. So for 2020 or Q4 2025, they're guiding, or analysts are guiding for 379 million, which is interesting because Zeta themselves guided for around 300. I guess the 379 million is the midpoint of what they guided for. And let me zoom in here. Let me actually not go as far back so you guys can see this a little better. We'll make that a bar chart. So again, they're guiding for 379.3 million. I think they'll beat that by a little bit, maybe 385 million if I were to guess. And if we look at 2026 for full year, they are guiding for actually let's take a look on 2026. Let's go all the way here. 1.73 billion, which is what again what Zeta gave as their guidance, and I think that will be heavily beat in my opinion. But that's more of the guidance there. Now, if we take a look at, and I want to kind of show this as I feel like it's super interesting. Let's take a look at their valuation because I feel like this is something that I'm harping on a lot, and I want to get you guys to understand why I think it's undervalued. So if I pull up Zeta, let me go ahead and let's pull in a few other names that are just in the SaaS space. Obviously, not the exact same company, but just to give you an idea of where companies typically tend to trade in these zones. So I'm going to pull in just a few names that I can think of off the top of my head. Adobe may not be best, but I'm going to do it anyway. Let me go ahead and pull in, I mean, maybe even a Meta, different company, pull in an app, another different company, pull in Trade Desk. Interesting that Trade Desk isn't here. Well, anyway, so these are all of the, I want to go ahead and pull in all of their price to sales. Let me go ahead and make sure it's single panel. So again, we have the classic app trades at a 23 price to sales, CrowdStrike 22 price to sales. These are high quality companies with insane, adjusted free cash flow margins, growing 25-30% a year. But keep in mind, Zeta is guiding for that. I think it's 34% growth for full year 26, which I think is sandbagged, and they'll come in around that 36 to 37% growth. But guidance is super key next quarter, and so I'll be, keeping my peeking. I'll see if what that looks like. But again, if we pull out, let's go ahead and get rid of crowd. Oops, did not mean to do that. Let's go ahead and get rid of CrowdStrike. Let's get rid of app, as we know they're much higher. Meta trades at an 8 price of sales, which again isn't the best example or use case because it is a much larger tech company and they're far more profitable. They're not in early stage growth, although they are guiding for 30%. But here's probably better comparable companies. So we go ahead and do recently. Now, we can thank a lot of the SaaS sell-off to see this multiple compression. I mean, we can see in what was this March of last year during kind of a big move for the market in the summer. The price of sales were up there a little bit, but now we have, Adobe's at a 4 price of sales, HubSpot, which is a CRM sort of marketing competitor, they're at a 4.2 price of sales, and then the Salesforce is at 4.4. And then we have the lonely little Zeta down at a below a 3 price of sales. Guys, they're going to grow 30, okay, let's say it minimally 34% in 2026. They're going to have 13 to 14% free cash flow margins. They're going to become GAAP profitable. They're going to, and in my opinion, all of that is sandbag, but we'll just assume that it's true. Even if we give them a price of sales of, like I've been talking about before, which I think is relatively fair, above a 5. All these names are all undervalued, by the way. But I'm just trying to, give an example of how more undervalued Zeta is, in my opinion. And so I think if it trades in the range, which I think is a fair price of sales of around 5 to 7, somewhere in that range, a price sales of 6, that puts the stock at around, and let's go ahead and pull up the stock price because why not? Pull up the stock price. Want to make sure we can get, let's go ahead and get rid of, now that we know the companies, the stock price of $15, even if it trades at a price of sales, let's say they do, like I said, 1.8 billion, price of sales of 5 puts them at around, all you have to do is multiply the revenue times that price of sales multiple. So let's give them multiple sales or price of sales of 5. They do 1.8 billion. That is 5 times 1.8. Just doing quick math, I can do this in my head, but just to go ahead, that puts them at $9 billion company. They currently trade, and if I take a look on Robinhood, let me go ahead and pull up their chart and get some facts there in terms of market cap. So again, go ahead, pull up Zeta here. They trade at a market cap of 3.4 billion. You give them a $9 billion market cap, again, very rough numbers. Let's just say they don't dilute at all, which is not true. It won't happen. And we do the 3.9 divided by 3.74. That gives us 2.4. We multiply that times 15, 22, which is the price of the stock. That gives you a $36 share count or share price. And that is if they don't dilute. Now, they will dilute a little bit. So let's just say a $32 share price, which is essentially a double from today. And this is what I've kind of been harping on. Obviously, I've been harping on it for about 8 weeks now. And it isn't looking great for me as the stock has gone down. I mean, let's take a look here. It's gone down, what, 25% in a month, 15% past 3 months, 26% year to date. And so it's getting hammered. But again, my thesis hasn't changed. I still believe they're extremely undervalued and even more undervalued than they were when I was talking about them a month ago. Um, and yeah, I mean, even a fair price to sales of 6 puts them around a $32, $34 a share company. Um, and that's assuming they're lower end of the guidance. I don't even want to get into theorizing if they really come in and grow 38% and they come in and beat their adjusted free or their free cash flow margins and they come in and their operating margins are hit, a higher percentage, like 20%. I don't want to get to that state because that, I don't want to get too bullish. To be conservative based off their guidance, their numbers, their estimates, extremely undervalued in terms of a share price. And I just wanted to kind of spend a quick 15, 20 minutes talking about why I think so and just their numbers. I'm excited for Q4. I will be live next week during earnings. Not entirely sure with who yet, but I will be live after hours to go over their earnings and dive in. As you guys have seen me live for Pagaya's and Nebius's and some other live streams. But again, I appreciate the support. Appreciate you guys following along. Have a good week, and I'll talk to you guys on the next one. Peace.